At BMO ETFs, all our investment tickers start with Z. That's right, Z, not Z. From ZSP to ZEB, we build solutions for the Canadian investor. So next time you invest, consider a Z instead.
Hey everybody, it's Larry Berman here. Earlier this week on BNN, I talked about this week potentially being a major inflection point and possible high for the year, certainly for the next couple of months as we go in through what otherwise is a seasonal weak period heading into September and October. So we've got the dog days of summer in front of us, seasonal weakness in front of us, equity market price for perfection, and a Goldilocks outcome. Let's take a look into the chart room and a bit of the data this week and see what we learned from the FOMC and from the committee who puts together the employment data that are going to be fired. Apparently, the Bureau of Labor Statistics calculates and does the surveys for non-farm payrolls, and reported on Friday that the change in payrolls was weaker than expected, 73K versus 104. But the key thing here was the last 2 months were revised significantly lower. If you recall, last month, we got a surprise to the upside of 147 when the actual was 14. The president applauded this number and threatened or is going to fire the person who puts the numbers together, according to a Truth Social. Truth is a joke. And so we lost jobs in manufacturing. The jobs that we did gain were almost all health services. And so when you look at the cohort of the working age population, 25 to 60 kind of range, that group is struggling to expand. So the labor situation after this number has taken a significant downturn. Now, had the Fed and Powell seen these numbers earlier this week, they may have cut rates 25 basis points, or certainly signaled that was possible. After this report, yes, there's 2 more before they have to decide again. But for the most part, at 4.2%, we're at full employment and there's no urgency here. But if this weakness in the labor force persists, the 3-month average is now 35,000. Okay. So when you look at the 3-month average, 6-month average, 12-month average, you can see a dramatic slowing in the labor situation. When we look at the ISM numbers, and you look at them, below 50, we have manufacturing in recession. We have construction in recession. The labor market is still positive, but is really taken a sharp downturn. When you look at inflation expectations, on the higher side, when you look at the core PCE, surprised on the higher side. So you do have this stagflationary setup coming. And while following the Fed 2 days ago to where we are now, so pricing in 2.5 rate cuts between now and the December meeting, with almost certainty now of a rate cut in September. 2 days ago, post-Fed meeting, not even 1.5 rate cuts to the end of the year, and less than a coin flip for September. So clearly the employment picture has changed the balance between growth and inflation considerably. SOFR contract for June 2026. So we're looking about 1 year out, moved from yesterday's close from 42 to 72, like one and a quarter, 1.5 rate cuts on that data. So big. If we continue to see that type of weakness, it'll take the better part of the next month to figure that out. But we're starting to really pay attention to what that might mean for earnings. Remember, August 1st here, tariffs just beginning, 35% against Canada. I got a message for you, Mr. President. You're out to lunch on what you're doing here. I get it. It's a tactical negotiation, but we haven't seen much yet. It's turning into a mess. When we hear on earnings reports from corporate America, they're all very, very concerned of what this is going to mean. The average car produced in the U.S. is going to cost several $1,000s more. So let's see, but this is a challenge. So when we look at the different parts of the yield curve by way of ETFs this year, the long end, as of the 31st, up 1.6%, almost double that today in terms of the performance. I think it actually did. All other parts of the yield curve, this being the long end with a covered call and the performance, year to date. So IEF here, the best performing part of the curve is the 7 to 10 year part. And that's really the steepening that we've seen in a big way, where, bang for duration buck is in that part of the curve. The best part of that rally is probably behind us at this point. The long end has got to pick up steam if we're going to go into a hard landing. So I really like TLT here to protect portfolios is the message. It's our biggest position. In fact, in our bond fund for Q Wealth clients, we're as long duration as we can possibly be, and that's out to 10 years. When you think about the bond index duration in the US, it's around 6, it's around 7 in Canada. So we're making a significant bet that the economies are going to be slowing here. We talked about inflection point this week. Good news on earnings from Microsoft and Meta, for the most part Apple. Big reversal on the charts this week. So we'll see how this plays out. Very, very high probability. This is the high, at least until we get into the positive seasonals later in the year. But a lot of that's going to depend on how it plays out with growth and inflation on tariffs, and we can't know that yet. Very possibly this could be the high for the year in terms of US equities, in terms of tech, in terms of artificial intelligence leading that charge. Anyways, that's the message the market sent this week. I know it's not a great one, but govern yourself accordingly. Have a wonderful end of the summer here.